Buy a YouTube channel. Invest in real estate. Angel invest in startups. If you listen to modern financial influencers, you are supposed to be doing all of these at once. But treating 15 distinct asset classes with the same level of priority creates a significant risk of burnout and financial loss. Most of this advice is missing a crucial filter: your current life stage and your available resources. What works for a billionaire protecting a legacy can bankrupt a beginner trying to escape a 9-to-5. Without a way to filter these options, you end up collecting assets that don't fit your life, forcing you to spend time you don't have on returns you can't afford to wait for. To make sense of the noise, we need to map these assets onto a single matrix. The vertical axis tracks time and skill. This represents the sweat equity, the late nights, the stress, and the daily management and asset demands. The horizontal axis tracks capital. This is the liquid cash required to enter the game and survive any market downturns. We are going to sort all 15 assets into their correct quadrants based on their true cost of entry, stripping away the marketing hype to see what they actually require. We start in the top left, the foundation. These assets require massive time inputs, but almost zero upfront cash. This chart shows the measurable link between health and earning capacity. Individuals in the top 1% of income live nearly 15 years longer than those in the bottom. High-income skills and physical health form the operating system for your wealth, requiring thousands of hours of active effort to develop. Reputation and network sit here as well. These are non-financial assets that provide access to deal flow and capital that money alone cannot buy. This quadrant offers zero immediate financial returns. It demands a level of daily consistency that most people find difficult to maintain over several years. These foundation assets provide the initial leverage and income needed to fund every other investment on this list. Moving to the top right, we find the scalable hustles. This quadrant requires moderate capital and extremely high active management. Take business acquisitions. Using seller financing, you can buy an existing company using its own cash flow to pay off the debt. You skip the startup phase, but you take on the full weight of the company's daily operations. Intellectual property functions similarly. Elvis Presley's estate continues to earn because once the initial work was recorded, the cost of distribution drops to nearly zero. J.K. Rowling earns from books written decades ago, benefiting from an asset class where the work is front-loaded and the returns are long-tailed. Real estate and digital assets also live here. These rely on bank leverage or AI orchestration to create disproportionate upside for the owner. These assets behave like demanding second jobs. They require your constant presence and judgment to remain profitable. In the bottom right, we find the boring compounders. This is the realm of true passivity, requiring significant capital but essentially zero time. Index funds and dividend stocks operate through a reinvestment flywheel. As these companies earn, they distribute profits or grow in value, which you use to buy more shares, accelerating the process. Data from any 15-year period shows that 85% of professional money managers fail to beat a simple index fund. Passive strategies frequently outlast active management over long horizons. The difficulty here is the pace. To see the full impact of compounding, you have to leave the capital untouched for decades. These assets lack short-term lifestyle perks, but they provide the most reliable statistical foundation for long-term wealth. The final group is the preservers and moonshots. These require extreme capital and specialized network access, but very little daily time. Warren Buffett holds hundreds of acres of farmland because you cannot manufacture more of it. It serves as a hedge against inflation and a protection for capital during periods of currency debasement. Angel investing and private equity represent the moonshots. These offer the highest potential returns on the list, but they come with a high probability of total loss for those without experience. Children's education also sits here as a preservation tool. Since 70% of wealthy families lose their fortune by the second generation, the investment here is in financial wisdom rather than just tuition. This quadrant is designed for those who have already built significant wealth and have the capital to absorb years of zero yields or total losses in exchange for long-term protection. Selecting an asset depends entirely on your current bandwidth. If you lack capital, focus exclusively on the foundation quadrant. Invest in your skills and health until your income allows you to buy into other quadrants. If you have capital, choose your level of involvement. If you have the time to lead, look for active leverage in Group 2. If you want your money to work without you, move directly into Groups 3 and 4. The mapping process reveals where you stand. Today, the gap between understanding these assets and actually seeing your net worth change is the decision to start. Assess your current time and capital, then pick the single quadrant that matches your current reality. Building wealth requires a specific trade-off of either time or capital.